Hello, YouTube. Is it time for the market to have a corrective way for us to go back down closer to 432 on SPY and potentially as low as about 410? That's what we want to review today. So it's going to be a quick update because we do have our stream today, but let's go through and see what we have. Why? Well, because to start the month off of September, they are wrong if they think that we're going to be going higher. And that is pretty obvious because right now we're red on the month. We opened up at 453 and the high is 453. So we opened up the month and we just went straight down. We did not do this first part here, which means the bulls were a little bit missing. This is what's happened over the average of the last 20 years, but this is what's happened over the average of the last 30 years. September can be a terrible month. It can be a great month. It can be a terrible month. 1, 2, 3. Well, we got 1, 2, 3, 4. And so far we are red into September. So are we going to repeat the worst of the declines where it gets bad, worse, worse, and then terrible? Bad, worse, worse is terrible coming. So who's wrong? One of these teams is. It's either the bull team or the bear team. Let's look through a little bit more evidence to see exactly who could be wrong. And that's why I said they are wrong. Why? Because I think both teams might be wrong. Being right here at roughly 50% or neutral, I think it's up to either team to push it. So I think that next week, the most important data point is going to be Wednesday when we got CPI coming out on Wednesday at 8:30 a.m. This number here looks like it might be a negative reaction. Why? It's going back to 0.5% or compounding at a rate of 6% when right now we're at 3.2. I do not know what this number here is yet. We can also note that core CPI is flatlining at 2. But when we looked at the heat map yesterday, we talked about how on a 1-month performance, energy's been doing pretty good. And I don't know about you, I've been noticing the price of the pump going up a little bit more. So that kind of tells me that maybe we're going to see a surprise in CPI. And this will be very important when we look at the charts in a moment here. But look at these dates. Wednesday, September 13th, we got PPI, but I'm really just focused on the CPI number. And then we got the big bad Fed. When? Coming in the next Wednesday, September 20th, when we're going to get what? There's a little asterisk here. The asterisk means that this is a meeting associated with a summary of economic projections, or the SEP. That'll be critical for the Fed this time. So think about this. This is next week. Then we have the following week. And then we got one more week. So if we go back here to our seasonality chart to try to get a grasp on what that could mean, it means that if we're going to get one team being wrong, well, Apple might have been the lift for us to rally into the Fed. It doesn't look like they will be. There's been a huge hit on Apple. Maybe we're going to go down on the Fed. That's what looks like it happens in a normal year. If we're going to get this big, bad, nasty red, I'll show you specifically how it's going to happen right now. And then we'll leave you with a plan at the very end of the video. But before I do that, I'm going to ask you for a giant favor, please and thank you. If you could please consider smashing that thumbs up and subscribing to the channel, I would really, really, really appreciate that. Thank you so much ahead of time. So we've been talking about this pattern here where an inside bar and the short-term break the break of that inside bar usually leads to the short-term trend. I want to pop over to a different chart though. Why? Because right here is where we got this scary chart where we got a three down week candle, a 1 dead cat bounce, and then a bearish engulfing to close it out. Well, we know we're looking at the yellow boxes. So yellow box number 1, yellow box number 2, and this is every crash so far this year. So if we're going to go in for another crash, is the recipe close enough to matching? Let's look and see. So what we've been talking about is the 3 down weeks, 1 dead cat bounce, bearish engulfing. 3 down weeks, 1 dead cat bounce, bearish engulfing. We got 3 down weeks, we got 2 up weeks, and then we got an inside bar. It's tight. It's tight. It's tight. However, I would say that for this recipe, it's pretty close. It's not perfect. It's not exact, but I'd say it's pretty close. And this matters because if we're going to go into that corrective wave, I'm seeing enough of the warning signs that my radar is buzzing. So now that we look here at SPX, let's pop back over here to SPY because we want to think about this note that is laid out here. It tells us that after we have a 5% dip, we crash, land, bounce. So crash, bounce, but no break yet. Bulls are playing defense. We're still trending up. Cannot ignore that. But if we look at this last note here one more time, an inside bar, the break of that inside bar is likely going to be the short-term trend. Well, we have an inside bar here. So think about this. If we go down next week and we lose the low, what does that mean? It means that we're probably getting a negative reaction to the CPI print. Why would that matter? Well, the next week we got the Fed. So if there's a negative reaction to CPI, it likely means people are scared about the Fed the following week. which would lead to what? Maybe more losses. We go back down into fear, market starts to tank, and we get our crash, or we get that big corrective wave. However, on the flip side, if this inside bar breaks bullish, that exact area that we mentioned to fail at earlier this month at 451.76, let's call it 452, that would be a higher high next week. So we got 45106. If we make it to 452 or print a monthly higher high, sorry, weekly higher high, that would likely mean that we have a positive reaction to CPI, and we're likely going to have a positive reaction to the Fed. So if it's not very clear, the plan of attack right now is to make sure that you're prepared for the inside bar break. And as we all know, stocks take the staircase up and the elevator down. So let's look here objectively. Well, it's been a pretty good grind higher. So we haven't had a real crash going all the way back here to February. It's been a long time. We've not yet really had a crash of more than 5%. Last thing to look at here is going to be the short-term momentum we looked at yesterday. So we're going to look at our club, meaning the below 50 DMA club, and see if we made any progress. So the S&P, as of right now, we've hit the 50 MA, but we're not yet over it. We're currently set. It could be a pass, could be a fail for 3 daily candle closes below that average. We're just looking at whether or not we're above or below the blue line. And we got XIU or Canada set for 3 days below. So the US is down. Canada is down. Who else is down? Well, QQQ is up. So they're not listening to Rebecca Black today, right? Got to get down on Friday. Well, not QQQ. QQQ open on the 50 and push higher. So 1 day below and then right back above. It looks pretty constructive. SMH 2 days below. That's the start of a trend. Gap as well. Nvidia holding over. That short-term price is acting as support. Apple 2 days below, trying to fill the gap. Is it going to do what it did last time? Try to fill the gap and then fail? Try to fill the gap and then fail? I'm not sure. This is the biggest stock. It really matters. $200 billion wipeout, as I noted right here, and we talked about yesterday. So that's really important. Tesla, below again. This will be at least the 3rd day below. Looking here to FXI, it's 4 days below. So as much as China tried to hurt America, they hurt themselves worse. Remember that G20 summit is underway right now. Bill Microsoft back over the 50 MA, flirting with the high from 2022 at 338. Can Microsoft come and drag Apple higher? Or is it all going to be for nothing, right? Where we get a big old nasty red candle. All right, moving forward. It's pretty mixed. ARK is below. DAX is below. EEM is below both the 50 and 200. Nikkei is still over. So Japan looks good. Tech looks good. Chips look bad. S&P looks bad. Ether looks bad. Bitcoin looks bad. A lot of things look bad. So anyways, that is our update for today. If you want to watch more, our weekend deep dives now queued up here on the left-hand side. If not, come tune in for our end-of-day stream at 3 p.m. Pacific, where we're going to talk about whether or not this is a trap. If not, thank you so much for watching, and I look forward to seeing you on the next video. Thank you again.